You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. All right, guys, welcome back. Episode number 150 of the Young Investors Podcast. We got there, Hamish. That's a pretty good milestone. It's a raise of the bat.
Yeah,
150 episodes.
It's ridiculous. I actually can't believe we're at 150. It's I can't believe quick. That. I mean, because we've almost done for a very long time now. We've done it every single week. So, but it is a little bit over. It must be a little bit over 3 years now, or just around that time, which is just crazy. Pity we can't do a live one, a live video podcast like we did at 50, and I think we did another one at 100, right? Or maybe it was like 105 or something.
I think we've done a few, and even after episode 100, I'm pretty sure we hit the major ones. We always like to do that. It's always good fun, celebrate the major milestones and do some sort of special episode, but not this time.
No, we'll have to, hopefully, assuming everything is, opened up next year, we'll do quite a few of them, I think. Because even, you're right, we hit the major ones, but then in between we've done a couple of other ones and they're always so fun to do. So, we'll definitely be making up for lost time, I think.
It's actually such a luxury just being able to talk. You don't, this is just like a little quirk, maybe a behind the scenes thing of the podcast. It's actually so much easier to do a podcast when you're actually looking at the other person that you're doing the podcast with. Yeah. It's just, we end up tripping over each other and, we end up, because it's hard to judge when someone's finished speaking over, video chat or just over audio chat. So, it's always so seamless. It runs so much better when we're in the same room, just like looking at each other.
Yeah. I find it really difficult to have remember the entire conversation when it's over just an audio podcast and where, we have our kind of notes document opened up. I find it really difficult. A lot of the time I kind of lose my train of thought. But in person it's just so much more free flowing. So hopefully we can get back at it. Probably not too far. I mean, I say this every week now, but I think probably in the next couple of months, next month or so should be good to go, I think.
Well, I think so. If we're just looking at the vaccination trends, I mean, we should be looking pretty sweet in a couple of months. And I don't know, I imagine once we kind of hit these 70, 80, 90% double vaccination targets, I can't imagine, I don't know, obviously, but I can't imagine that governments would want to keep everything locked down and, suffer those economic consequences. I have a feeling they'll let us get back to normal, which I hope is the case. Obviously, I don't know. But if that is the case, then that is super exciting because honestly, it could mean that, life gets pretty well back to normal in just a few short months. Yeah. Which I understand is actually already the case in many countries around the world. Australia is kind of a slow vaccination kind of country just because we actually didn't have very much COVID to begin with. So, it's just crazy to think that we might be back to some level of normality in 3 to 6 months.
Yeah, we've just gotta hope there isn't another strain that comes out that the vaccines don't work on. That would be that would
scientists are calling this the FU strain. Cop it. Fingers crossed anyway.
Yeah.
All right, what are we talking about today? Oh gosh, I want to hear from you about what's going down with ASOS. Jeez, I watched your video on ASOS, and that's such tough luck on that one.
I mean, I should have seen it coming. I spoke about this to some of my students earlier in the week. I should have seen this coming because after I invested in Thor Industries, the founder stepped down from the chair role pretty immediately afterwards. I invested in Texas Roadhouse. Pretty soon after that, the founder passed away.
I remember that actually.
And
we were in Melbourne together, I remember. Do you remember that story?
Yeah. We were recording the live podcast, and I spoke about Texas Roadhouse probably 4 or 5 times throughout that podcast, using it as an example, talking about management even, I think. And then at the end of the podcast, I just checked my emails, and there it was, the press release saying that he'd passed away, which is just crazy. And then of course, so this week I invested in ASOS, and 4 days later, the CEO who'd been at the company for 12 years stepped down. So obviously that's a major change. And the truth of the matter is, and I spoke about this in my video, is it actually makes a really interesting case study where I can kind of break down my thought process and my rationale for how I'm approaching it. So it is kind of good for content, I think, but it is kind of unfortunate because it's not something that is a short-term issue. It could be a fundamental change. Well, it is a fundamental change to the business.
It is, yeah.
It's just a matter of whether the new management team also fits my criteria. But you've got to I'm going to have to keep an objective look at the company and not fall into the trap of thinking, well, I'm invested in the company. I'm down on the stock a little bit now, so I kind of want to keep the investment. That all has to
hang in there.
Exactly. That all has to go out the window. I just have to look at the company, and if it doesn't meet the criteria anymore, it has to go. And that's the unfortunate unluckiness of some investing.
That is a tough run of luck, though. Honestly, it's just so. So unfortunate. You don't expect these things to happen, and you've had 3 of them.
Yeah, and I think that just speaks to the fact that there's always unexpected things happening in the markets. It hasn't, as far as it's gone, it hasn't really caused any substantial impact on my returns. That's a good thing. But there's always going to be things that happen, and this is just one example of it. So we're still waiting for the new CEO to be announced. So I think that's going to happen in mid-November probably. So a little bit of a waiting game at the moment, and I'm sure the stock's going to be extremely volatile until that announcement is made. Yeah,
just submit your application.
Yeah, I'm going to step up. Yeah, me and Brandon, we're going to be co-CEOs of the company. Yeah. I would.
Jeez, that'd be interesting.
The founder's still on the board, and he stepped away from the company in 2015 because of stress, and he said that he got quite burnt out from the business, and he wanted to pass it on to new management. But that would be quite something if he came back 5 years later. I don't think that's going to happen, but
no, probably not.
That would be kind of amazing.
Wow. What an eventful opening segment.
Yeah.
Should we we'll just quickly hit the sponsors bit and just get stuck into it, I guess?
Yeah, let's do it. So today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio, and it will allow you to track all of your gains. So capital gains, dividends, if you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies, and then you can also use it when it comes to tax time. So Sharesight generates up to 12 now, I believe, different reports that can be used for tracking your performance and your portfolio diversification and that sort of thing, as well as tracking your tax, working out things such as your capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So use that link, sign up to a free plan, track up to 10 holdings, and do that forever. Just use the free plan forever. It's really great. But you can also, of course, use that link to sign up to a premium plan for more features, more reporting. And if you do that, you'll get 4 months off a yearly subscription. So go check it out. It's a great deal. And even if you don't sign up to a premium plan, the free plan, you can use it forever. And it's awesome. I used the free plan for a really long time.
Yeah.
Go check it out.
Yeah, it's a good application. Yeah, and you do get a lot for free. That is true. Yeah. The free plan is pretty good. But we shouldn't be plugging the free plan. You really do want the paid plan, guys.
Yeah, I'm sorry. The free plan is terrible.
It's garbage. Gosh. Nah. All right. Where should we? Where do you want to start? You pick. Where should we start?
I actually want to start with this corporate tax stuff that you put in here, because this is something we've spoken about. We spoke about this probably a little while ago, this was kind of in motion. So kind of want to hear what the update is around this.
Yeah. So yeah, you're exactly right. This has kind of been led by Joey Biden. This is kind of right up his alley. He kind of wanted to get all the countries together and set a kind of global minimum corporate tax rate to kind of eliminate a little bit of this tax dodging that we see by big companies. So the story is that last Friday, 136 countries agreed to set a minimum corporate tax rate of 15%. Which you might say, 15% is still very low, but I actually think that's quite an impressive deal to get done, considering you got 136 countries to agree to that. So that is quite the effort, and obviously a lot of these countries are kind of tax haven countries. So to get to, I don't know whether it's kind of a bit of political force, forcing their hand a little bit to agree to it, but they were able to get it done. And I listened to a Wall Street Journal kind of mini doc podcast thing on it, and I'll read you a little snippet. This is where I got most of my information from. It says here, the goal of the deal is to eliminate tax havens and make it much more difficult for companies to take advantage of another country's lower taxes. Companies to take advantage of another country's lower taxes. Most countries were on board with the plan right away. But when the deal was being hashed out this summer, there were a few holdouts, specifically countries that would have to raise their taxes, countries like Ireland.
Surprise, surprise. Countries that have really low corporate tax rates, and every business has their payments business through their payments subsidiary.
Yeah. Exactly. So I was interested in this Ireland situation because I knew that Ireland, like you've said it before, is this kind of tax haven, but I didn't really understand it. So Ireland is, for those that don't know, considered the low tax hub of Europe. And actually it was in 2003 that they set their corporate tax rate to 12.5%. So that's pretty darn low.
That's really low. Our corporate tax rate is 28.5%, I think, and then 30% for companies over 10 million in revenue or something like that. So, it's a big difference.
It's not bad. Like, imagine conducting whatever business activities you like and only having to give up 12.5% of that to the tax man. I mean, that's a pretty good deal.
Pretty good.
And the audio clip that I listened to actually noted that obviously it worked really, really well for them because Ireland was pretty much just like an agricultural kind of backwater, they describe it as. It wasn't really a great place for business. But lowering the tax rate to 12.5% lured more than 1,000 US companies to set up shop in Ireland, including big names like Google and Facebook. So I found that really interesting. But now, obviously, their hand was forced. There is now a 15% minimum tax. So in Ireland's instance, they're obviously worried that these companies won't see any sort of benefit in staying in Ireland. So they'll just kind of move somewhere else with a 15% minimum tax rate that kind of works better for their business. So that's the kind of perspective from these countries that were relying on undercutting everyone else on their tax. Because I mean, you can kind of understand it because from Ireland's perspective, they lose out. They're going to lose out on tax revenue, even though the tax rate's going up. They're going to lose out on tax revenue as companies leave, and if companies start to leave, they also lose out on jobs as well. So,
it's a interesting situation. So I presume Ireland has to agree to do this, right? Or
they have agreed.
They have agreed. Yeah. Okay. So I don't know. It's interesting. I was very skeptical that they were going to be able to get a large number of countries on board because of this exact reason. Because there's countries like Ireland that, a specific part of their way of raising revenue is having low corporate tax rates. They're a relatively small country, so they can't take advantage of many of the other benefits that other countries have naturally, natural resources and a huge population to drive business and that sort of thing. So they use, these kinds of methods in order to have businesses basically just run their payments through the country and then collect the tax revenue on that. So yeah, it is. I'm fascinated to see that they got so many on board. How many? I don't look. I'm no geography expert. How many countries are there? Have they gotten like? I presume 136 is like a lot of the main ones.
There are 195 countries.
Okay.
There you go.
Right. Okay. So they've gotten a sizable chunk of them.
Yeah, quite a few. So I honestly, I think this is really good. Like, I think that this needs to happen. There's going to be arguments on both sides, but I'm pretty happy that there is a minimum corporate tax rate, and hopefully this does eliminate kind of tax haven places. But then the next step, of course, this is just like step one in the process, is kind of like everybody getting together and having a handshake kind of thing. The next step is to actually get this into law in each country. So estimates are at the moment that this minimum tax rate will be in effect in most places by 2023.
Right.
So they're hopeful that that's what will happen. But the other concern at the moment is, yes, maybe some countries are slow to actually get this into law, but the other concern is that will a minimum corporate tax rate actually help eliminate the effect of tax havens? Because I mean, if you're Ireland, for example, and you're just an agricultural backwater and you want to attract big companies to your country, instead of offering a lower tax rate, can you offer some other financial incentive to big business just to get them to stay in your country and keep employing your citizens? That's kind of the argument that the tax rate might not actually help all that much, because countries will just find another way to lure companies to their country.
Yeah. You could get a situation where I think if you look at like the US in, I think the mid 60s, they had the highest the highest individual tax rate for really wealthy individuals was 90%. And if you just look at that, you think, wow, that's really high. But what was actually happened was then there was a huge number of exemptions that meant that nobody ever paid anywhere near that amount. So you could see a similar situation where the headline number is, we have a 15% corporate tax rate, but the reading between the lines might be, there's so many exemptions that the effective tax rate for people in the country or for companies in the country is substantially lower. So you could definitely see something like that happen. And it would honestly make sense for countries like Ireland to do that, so that they still have an advantage and they keep those businesses there. Yeah. So there's no real reason why they wouldn't do something like that, or any reason why they wouldn't just, not honor the agreement. So very interesting. We'll have to see kind of how this plays out, who implements it, how it looks, whether there's countries that are outside of those 136 that go against it and are able to capture businesses by having a lower tax rate. I don't know. We'll have to see. Yeah,
that's the thing. I feel like that's a good point. Is that if you want all countries to have a minimum corporate tax, like you probably do want all countries, because I mean, sure, 136 is good and they're probably the major countries, but is there going to be, companies might start looking, okay, well, what's the next best option? What's the biggest economy, safest place to set up shop out of the X number of countries that weren't in the agreement? But yeah, we'll have to wait and see. Overall, I still think it's a good thing. Even if there's a couple of issues with it or potential problems, I still think it's good that, there are steps being taken to kind of level the playing field and eliminate tax havens. Because I think that's an issue that gets people citizens of many countries very frustrated, is the fact that big companies operate in their country. However, they don't pay tax in that country. They shovel that revenue into a tax haven and essentially screw over the country that they are working in. Yeah. So we'll have to wait and see what happens.
Yeah. Ideally, you would have some sort of a tax code that's extremely simple, and that the headline numbers are, the headline corporate tax rate rate is the effective tax rate that companies pay.
Yeah.
But that's not the case in many often. So yeah.
Case in reality.
We'll continue to see, I guess, how that evolves. I've got a couple of things I want to talk about, boring things, so I won't spend too much time on them. I want to talk about some news out of the Federal Reserve, and then also some stuff about the debt ceiling, which we spoke about a couple of weeks ago, I think now.
Yep.
But news today or earlier this week from the Federal Reserve was that there was a minutes, so basically a summary of a meeting that they had in September that was released this week. I don't know why that gets released so late. Like, we're halfway through. What are we in? We're halfway through October. And this was a meeting from, I think it was the 10th it was a number of meetings from the 10th to the 14th or something like that of September. So it's literally a month later that we get this, which is kind of weird. But from that meeting, we get to see kind of what they discussed, and a couple of things that we kind of already knew but have now been confirmed. So it was revealed that many members of the committee now admit that inflation is likely to be more persistent than it was initially projected. The quote here is that, yeah, shocker. It's the quote here is most participants saw inflation risks as weighted to the upside because of concerns that supply disruptions and labor shortages might last longer than and might have larger and more persistent effects on prices and wages than they currently assumed. Yeah, which is no shock to anybody. So that's kind of, what they discussed at the meeting. The meeting summary also indicated that many members believe that the Federal Reserve has come close to reaching their economic goals. So of course, the purpose of doing asset purchases and lowering interest rates and using these levers is to stimulate the economy and get it to a place where they want it to be. And many members believe that they're pretty close to being finished, it's likely that the Federal Reserve will slow down their money printing and asset purchasing in either November or December of this year. So pretty much, in a month to 2 months' time, they're going to start to slow down that money printing. So what does that actually mean? Currently, the Federal Reserve prints money and purchases about $80 billion of government bonds and $40 billion of mortgage-backed securities every single month. So they're just printing money, and not literally printing money, but they change the numbers digitally, printing money, and they buy these government bonds. For the most part, it's government bonds. Beginning next month, this could be dropped to $70 billion in government bonds and then $35 in mortgage-backed securities. So 10, 5 decline every single month, and the aim would be to reach 0, so no net purchasing by mid next year is kind of what they spoke about in the meeting. It also means that the US government, which is currently lining up a $3.5 trillion spending bill, will either need to slow down its spending or raise interest rates on its bonds, because how the Federal Reserve kind of acts in this machine is because the government is spending so much money, they need to take on a lot of debt, and they need someone to buy that debt. They need to get the money from somewhere, and they're not getting it from the public. There's not enough demand at 1% interest rates or whatever they are at right now.
Yeah.
So the Federal Reserve has to step in and artificially act as the buyer. And that's going to be slowing down over the next year, which means that, to attract, to spend money, to take on more debt, they're going to need to attract investors, and that means raising interest rates, and that's of course going to cause some volatility in the stock market. So that's interesting. A little bit more of the same, I think, of what we've spoken about, but kind of just seeing it progress slowly, and we'll see over the next 2 months whether they actually do begin doing those wind backs on their spending. The other thing I wanted to talk about, which is also kind of boring, stay awake, guys. Keep your eyes open. Yeah. It's almost over.
Do some squats. Everyone stand up. All right, let's go.
Have a coffee.
And stretch to the left and stretch to the right and touch your toes. Oh, and sit back down. Take a deep breath. And all right, what's next, Hamish?
All right, let's talk about the debt ceiling, which is a riveting topic. So a couple of weeks ago, we spoke about how there's a limit that is placed on government debt. And of course, yes. In August, that ceiling was passed. They actually passed the amount of debt that they can take on, and they were expected to run out of money in October. And we're in the middle of October. Right. So if that had been allowed to run on, which it didn't, it would have been the first ever default from the US government, which would have been crazy. That would have just been thrown the markets into absolute chaos. I think everyone would have agreed that the markets probably would have, the global economy would have probably collapsed. So, not a great thing to have happen. And
it's so funny because we just kind of, it's just assumed, like, for forever I've said, T-bills, that people call it the risk-free rate. It's like you buy treasury bonds if you literally don't want to take on any risk whatsoever. So then it'd be like, holy smokes, what?
And I mean, they were really close. So essentially, in order to raise the ceiling, I spoke about this a couple of weeks ago. If you want to hear a little bit more about this, they needed the Democrats needed support from Republicans in the Senate, who have, I think, so in the Senate, the Democrats have 48 seats, Republicans have 50. So, and they need 60 seats to get 60 votes to get it passed. So, they need quite a few Republicans to get on board. And Republicans are using this opportunity to leverage changes in that $3.5 trillion spending bill because Republicans do not want the bill to be that big. So it's kind of a bit of a political stalemate at the moment. However, this week, a temporary fix was found, emphasis on temporary. The Democrats found a technical procedure which only required 10 votes from Republicans and would allow the Democrats to then pass a temporary bill with a simple majority, which they were able to achieve. They had 11 Republicans on board and they were able to increase or push out the borrowing limit until December. So,
right.
This is absolutely a temporary solution. They've literally kicked the can down the road.
Patch job.
So they've got another 2 months to kind of negotiate with Republicans. But they also did a vote on raising the debt ceiling, of course, and they had 0 Republican support. So they're in a bit of a pickle at the moment with what's going to happen. And I think it's very clear that Republicans are going to be using this to try and stop the huge amount of spending that the Democrats want to do. Either that or they're just going to allow this to persist and use it as kind of an argument for voting Republican in the next election. So it's a big issue at the moment. I think it's very unlikely that we will see the US default, but there's still more to come from this story. It's certainly not just going away just yet.
Yeah, it's interesting, isn't it? Yeah. It does. It sounds as though those 11 Republicans that supported the temporary fix are literally just in favor of the temporary fix. They're not actually interested in raising it on a more permanent basis. They probably just voted for the temporary fix just so that the world didn't fall into chaos.
Yeah, exactly. I think that there are a lot of people who probably don't want to see the global economy collapse, and for everyone to start doubting whether the US government is as solid or the government debt is as solid as it has been for so long. But yeah, what we will see in terms of how this affects what Democrats can get through in their spending bill, I don't know. We'll kind of have to see.
And that's the only point that I was going to raise, is that this kind of thing, any issue like this is kind of just ammunition for the Republicans. It turns, like everything these days, just turns political, doesn't it?
Yeah.
So this is just political ammunition. Now, the problem needs to be solved. The Democrats are the ones that have, I guess, have pushed America into this situation. And so they now need to find a solution. So because they need to find a solution, and Republicans hold the last few votes to actually get that solution made, then obviously it's just political kind of ammunition, I guess, from the Republicans. But it's very, very interesting, man. Just everything turns so political these days. So political.
Yeah.
But hey, that's democracy, I guess, and I'd rather have a democracy than not.
Yeah, exactly that. All right, I'm finished, guys. You can.
Oh, you're done?
Yeah, I'm done. I'm
okay.
done. That's it. That's all I've got. Okay,
everyone. Open your eyes. No, to be honest, what have I? Oh no, I'm going to talk about something that's a little bit more interesting than debt. To be honest, to be fair, you did make it as interesting as it could possibly be. It's not a great subject, but I think if you had to do an assignment on it, I'd give you good marks.
Oh, thank you. I gave it a bit of tone. Gave it a bit of
engaging presentation.
Oh,
Man, you should make YouTube videos or something.
Oh,
I think you'd be good at it.
Yeah, it's a great idea. Yeah.
No, but okay. So let's talk. So we'll do one more news story, and then we've got we actually kept this episode pretty light on the news because we've just got, as we said last week, we've got a mountain of Q&A questions now, which we like. We're not complaining. We definitely like hearing from you guys. So we'll get to those in a second. But first, Blue Origin, Jeff Bezos's little space company. They launched William Shatner to space.
Wow.
How's that for a headline? Captain Kirk himself, hey?
Wow.
Yeah.
I missed this completely. I have no idea what this story is. So
I think it happened overnight because I just woke up and saw the headline. I was like, what? I did not know that was happening. Which is surprising because I actually keep up to date with this sort of stuff. I find it very interesting.
Yeah.
But yeah, the article reads that Jeff Bezos' Blue Origin launched its New Shepard rocket for the 5th time this year on Wednesday, with Canadian actor William Shatner joining. Called NS-18, this New Shepard mission carried a crew of 4. Shatner, then Blue Origin VP of Mission and Flight Operations Audrey Powers, Planet Labs co-founder Chris Boschisen, and Medidata co-founder Glenn DeVries. Shatner, who famously played Captain Kirk in the original Star Trek television series, is now the oldest person to fly into space. And I was gobsmacked at how old William Shatner is. I had no idea. He is 90.
Whoa.
He is 90.
That's kind of crazy. I don't know if I would be doing that at 90.
Yeah. Well, I mean, why not? I mean, who cares? Like, you're already on the way out. So, if your rocket explodes, who cares? You haven't sacrificed that many years of your life if something goes wrong. It's worth a risk, I reckon, at 90. Start taking risks you wouldn't normally.
I mean, I guess. I don't know.
You don't agree with my philosophy at all.
I just don't think I'd want to die blowing up.
Oh, where's your sense of adventure, Hamish?
Yeah, I'm a little bit more conservative.
Anyway, so yeah, New Shepard's capsule accelerated to more than 3 times the speed of sound to pass beyond the 80-kilometer boundary, the boundary of what they deem to be space. And the capsule was flown autonomously with no human pilot and returned under a set of parachutes to land in the Texas desert. The New Shepard rocket booster is also reusable, and it landed on a concrete launch pad near the launch site. So that was the mission. But the reason I chuck this in, firstly, is because I'm interested in this kind of space tourism thing, because it's very new. It's a very new industry that's kind of just in its infancy. So it's kind of just like an interesting business case study to watch. But the question I have is like, what does a ticket to space end up costing? That's what I really want. Because in all honesty, down the track, when the prices come down a bit, I would be so keen to go to space. That would be awesome. That would be so cool. I feel like you give it another couple of decades of de-risking and all the rest of it, and I feel like that would be an awesome, like, once in a lifetime thing to do. But I have just no idea what the potential price could potentially, like, what would be a standard ticket price, because Blue Origin doesn't release how much a ticket costs. Right. We've got Virgin Galactic, and this is all happening at the moment. So it's like this is the start of the industry where everything's super expensive. Virgin Galactic previously sold tickets for $250,000, but recently hiked the price to $450,000. Get this, next year SpaceX is running a mission called Axiom Mission 1, where they're going to fly 4 astronauts up to the International Space Station, and they'll get to stay on the ISS for 8 days. How insane is that?
That's really cool. That's something
cool.
Yeah, I feel like I would be more interested in that than just going into technically being in space, if that makes sense.
Yeah. Hotel ISS. I think that'd be so cool. But that's the crazy thing. Tickets for that one cost $55 million.
Get out of here.
Yeah. But I mean, you can kind of understand it. It's like a 10-day trip. It's the rocket up, but it's also the stay on the space station and whatnot. Yeah. We've also got one of the seats on Jeff Bezos's flight that he went up on, auctioned and sold for $28 million. But that was obviously an auction. It wasn't like a preset price by the company. So, it's actually quite hard to figure out, if you just wanted to go up to space, how much is this going to cost you? And obviously we're in the early days of space tourism. So as I said before, the price is just ridiculously high. But I do want to know, like, what is the price? So say, maybe I'll phrase it like this. What's the price of a ticket if you say cover cost and then add a 20% margin for the business? Once you factor in launch costs, operational costs, and then, the business taking a 20% cut, then what's the price of a ticket? And it's something that honestly is just not, it's data that's just not available right now. But I'd be really, really interested. Elon Musk, he hopes that one day the SpaceX tickets cost $100,000 per flight, but that's obviously just like a guess, a long-term guess at what he would like to achieve. But it's interesting, isn't it? Yeah.
I mean, of course, it's something that will progressively get cheaper and cheaper. Or you would imagine it would, with technology advancing and there being more interest in this area and more competition, but. Yeah, I don't know. It's certainly going to be extremely expensive for the foreseeable future, I think. But yeah, I don't know. I'm not.
Would you do it one day?
Probably not. I'm not interested at all in just going into space and being technically in space, like the last few trips we've seen where they just go slightly into. I don't even know how far out they go, but they just pass the limit that people call space. And then
I think it's like 80 kilometers or something.
Yeah. So I'm not, I'd be more interested, as I said, in actually going and staying in space for a period of time. But yeah, probably not. I don't know. It's not high on my list. I'll say that.
Right. Okay.
Yeah. You're a lot more interested than I am.
Oh, to me, I've always found space very, very fascinating. Like the whole, I remember watching the new Cosmos series by Neil deGrasse Tyson and how he was talking about, what black holes are and how they form and all this sort of stuff and, dark matter. It's just, it blows your mind. It just I don't know anything about this stuff. I'm not a big kind of science nerd, kind of big brain, but I do find it incredibly interesting. And I just think, I always remember, and this is what a lot of people were talking about back when the moon landing happened, is that shot of Earth, the tiny little blue planet. It would just be crazy to be able to, I think the coolest thing would be observing Earth just going around and all the clouds and all the countries passing underneath your window and just being able to watch that. Just kind of like, people watching, or, if you ever get an apartment or a hotel where you're up on the like 5th story overlooking an intersection, kind of how you can just kind of look down and watch the intersection kind of thing. I just think that would be really, really cool.
Yeah, that's true. I should clarify. I'm fascinated by space and that would be an incredible experience. I just think I'm too scared to do it. I don't think I'm the right person to just get in a rocket and be comfortable doing that. I don't know. That's just my thing. It's probably irrational, especially, if you go 50 years down the line, it's maybe a lot safer than it is now. And now it's even, at a reasonable level of safety if they're sending people up. So, but even then, I don't know. I'm just, it's one of those things that I'm risk averse to it.
Yeah, I'd be like totally pumped for it until the day came and I sat in the rocket, and then I'd be like, get me out of here, please. I'd be so scared.
That would just be a horrible way to die.
Wouldn't be great, would it?
That would be probably one of the worst ways you could die. So not my cup of tea, that's for sure. But yeah, if you could just if you could just teleport me up there and I didn't feel a thing, then sure, I would do that in a heartbeat.
Yeah. It's like Elon Musk. Elon Musk, one of his sayings is I think it'd be cool to be born on Earth and die on Mars. I just don't want to die on impact. That's a good one of his quotes.
Oh, that's very good.
Anyway, should we do some Q&A?
Yeah. I'm glad we've got some time to do like probably maybe 3, 4. So we'll see, I guess, how long we take through each one. But we can get through a good chunk of Q&A here because we've got a lot. And I'm sure there's a lot of people who've asked questions here who are hoping we can get to some of them. So we'll do our best to get through them. But as always, just because we have a lot of questions to get through doesn't mean we don't want more. So you can head over to the YouTube version of the podcast at youtube.com/The Young Investors Podcast. And just click on the latest episode and leave your questions as a comment there. And we just grab all of them and we go through.
Chuck them in the Google Doc and off we go.
And we just scroll through and pick a random one and let's go.
Pretty much. That's pretty much what we do. It's very high tech here at the Young Investors Podcast.
Yeah, it is. Maybe, do you want to ask, this is a quick one all the way down the bottom. This one's to me.
Yeah.
So maybe ask this one to me and then we can,
all right,
roll into some other ones.
I like it. I like the way it's phrased. Quick question for the H-Dog.
Yeah, that's nice.
Loved your latest investment in ASOS. Just wondering which broker you use to buy on the London Stock Exchange. I love that.
Beautiful.
How do you buy on the London Stock Exchange here in Australia? Or did you end up buying over-the-counter ADRs? Thanks, guys. Keep it up.
Yeah,
what did you do, Hamish?
Yeah, what did I do? No, this is a really quick answer. So I bought it directly on the London Stock Exchange. You can buy through the New York Stock Exchange over the counter, but it's generally preferred if you can buy the direct listing rather than an OTC, just because there's a lot less volume a lot of the time, and it can be a lot more difficult to get a trade through, and there can be higher costs associated with it. So, and it's relatively simple to trade directly on the London Stock Exchange from the US or from Australia. Not every broker will offer it, and a lot of brokers will have extremely high prices, so you will have to check that before you make the trade. But there are ones that do it relatively cheaply. So it's always best to, I think, go direct. Unless you have some, I guess the caveat to that is unless you have a very good reason to believe that the ADR is really solid. So I guess in the case of Alibaba, a lot of people are buying the US ADR, and a lot of people are doing that because big investors are also buying that ADR. So I guess that kind of gives you a good reason to buy it. But other than that, directly seems to be the way to go.
Yeah. And also the Alibaba ADR is listed
not over the counter.
Yeah, it's not over the counter. It's listed on the New York Stock Exchange, I do believe.
It's a dual listing. Yeah.
Yeah, true. It's also in Hong Kong as well. And actually, it's in Frankfurt as well.
Wow.
So there you go.
There you go. All right. So that was just a quick one. I'll ask one to you. Where did you?
Sure.
I'll ask this one. Yep.
All right.
Beat me to it. Hey lads, when I first started investing and doing my research on how I should go about it, the word diversification came up a lot. Investing in an index or a market tracking ETF is a safe and steady way to invest and grow your wealth. However, good old Daddy Buffett. I love how some of these. I love
the phrasing. You guys are killing it on the phrasing of your questions. This is fantastic.
This is beautiful. However, good old Daddy Buffett. He said, if you know how to invest in wonderful businesses, owning 3 of those is all you need to do very well. So what are your thoughts on only owning 1 to 3 businesses that you know inside and out and have a very strong conviction in?
Yeah, I agree. I agree with old Daddy Buffett. He's right. You do only need 1, 2, 3 businesses, like really killer investments, and you will be fine. The thing that people forget about that saying is that Buffett's also of the opinion that, over your whole investing career of 40, 50 years, he's kind of the opinion that you should imagine you've got a punch card and it's got 20 punches in it. And those punches represent investments you can make. And once you've made all 20, then that's it. Your punch card, that's it. That's your investing career. So is very much of the opinion just to wait and wait and wait, keep researching, and wait and just keep waiting until you find the investment that is absolutely just in the zone. It is, you know it inside and out. You've done all the research. You know it's a killer business. It's got a massive moat. Long-term the growth looks fantastic, and some short-term event that's barely even relevant to this business has just sent the shares down by 90%. Then it's just like, holy smokes, I've waited 10 years for this opportunity, but I've finally got it. And if you find those, then 1, 2, 3 businesses is all that you need. And it does come down to your understanding the business. You just have to know it inside and out to find those opportunities. But at the same time, if you don't feel confident in finding those opportunities, or you're not 100% sure that this is a killer opportunity for the long term, then that's okay. Like, it doesn't matter if you studied the way that Warren Buffett goes about it and you understand, this is a great strategy, but honestly, I don't think I'm interested enough in the stock market to be able to wait and know enough about these companies to dive into 1 or 3 or 5 over my entire lifetime, or whatever, or 20 over my entire lifetime, then it's fine just to go diversification and be a passive investor. There's no shame in doing that. In fact, in many ways, I admire people that acknowledge that, I think that passive investing is the right strategy for me. I definitely admire people that say that, and it's a great strategy, and Buffett himself recommends it, and it does very well over the long term. So I think that there are, I agree with both schools of thought. Diversification, ETF investing, go for it if that's the way you want to do it. I also agree with Buffett how you should, diversification is protection against ignorance kind of thing. And you could own 1 or 3 businesses. I mean, that's a perfectly valid business as well, but you have to make sure you're on top of the investments you make. Yeah,
100% agree with that. I think I certainly agree with Buffett that if you find, a couple of wonderful businesses and get them at great prices, then, your portfolio will do extremely well over time. But the key word in there is, if you know how to invest in wonderful businesses. And I think for the vast majority of people, and Buffett agrees with this, going broad into market tracking ETFs is probably going to be the best outcome. I don't think there's really a middle ground. It's either you completely step away from the market and be a passive investor, or you're willing to dedicate a significant amount of time and research to finding good investments. If you're in the middle, you're probably going to do worse than if you just use the market tracking index. So, for the vast majority of people, I think that makes sense. And that might seem strange from somebody who has a channel that's talking all about individual businesses and individual analysis and Warren Buffett's principles. But it's not really. I mean, my channel is for the small percentage of people who want to analyze individual businesses. And I think the advice for everybody else is relatively straightforward. So that's kind of where I sit. But if you're certainly somebody, and I think there would be a higher percentage of people listening to this and watching our channels that would fall into the bucket of someone who is willing to put in the work to analyze individual businesses, then I think you can certainly outperform the market, and certainly possible for you to do. Yeah,
it's definitely possible. Yeah, I think it's just much more a matter of emotion as opposed to being super smart. I think that's really the key to beating the market is just having the emotional
temperament.
Yeah, having the temperament just to be able to understand what to do and when to do it, and not to be freaked out. But anyway, that's kind of drifting into a different question, I guess. Can I ask you? I'll ask you this one here. My questions are: if you could only have knowledge from one book on investing, what would it be? And would you buy a company now if it was a great business trading at a margin of safety, but you thought a correction could occur and it might become even cheaper?
Yeah, a couple of really good questions there, I think. The first one is, and I've given this answer, I think, a lot of times, and I don't really have to think about it at all. The one book would be The Essays of Warren Buffett. And this is basically, I mean, it's not really, it is a book, but really what it is it's a collection of all of his Berkshire Hathaway letters and everything he's spoken about in terms of analyzing businesses and picking individual companies, all kind of consolidated into categories. So put into, rather than it being chronological from 1964, 1965, it's ordered in terms of valuation or corporate governance and competitive advantages, that sort of thing. So that book, it by far I think is the best because you get it straight from the horse's mouth, right? Yeah. So that's what book I would choose. In terms of your other question, so if I had a business that I thought was a great business and it's trading at a margin of safety, but I thought there was a correction coming, I think the truth is you never really know if a correction is coming. I personally don't think that you can tell, even in an individual business, whether there's more short-term pain coming for the stock. I just think that over a year, even over a 2-year period, maybe even a bit longer, that what a stock's price does is often extremely irrational and extremely unpredictable. So given that, you can only invest looking at what the market is offering you today. So if it's a really great business and you look at the price and it's a good deal, then you buy it. You don't have any kind of emotional attachment to what you think will happen to the stock in the future. And that's really the only way to go about it. I mean, think about my ASOS investment. I made a small investment and I thought it was a good deal. I could have easily thought, well, earnings are coming around next week. And competing businesses just had their earnings and all of their stocks went down after earnings. So I could have made a prediction about what was going to happen to the stock after earnings, but the truth was I didn't know what was going to happen. So I couldn't have made that trade, even though in hindsight now that looks like it would have been the right decision. There's no way I would have known that was going to happen. So just look at what the market's offering you today, and if it's good, buy. If it's not, don't.
Yep. I would agree. I agree with that. Agree with that sentiment entirely. The first part of the question, where the book that I would recommend, I think normally I would just say rule number one. In fact, I will say rule number one because I think for me anyway, it was just a really good. For someone that's a beginner, it was just a really good eye opener into the 4 key pillars of Warren Buffett's kind of strategy. Being, understanding the business, finding a moat, management, and then margin of safety. But I would also want to recommend the Dando Investor more for the valuation stuff, because the Dando Investor by Monish Pillai talks more about the discounted cash flow method as opposed to kind of Phil Town's margin of safety method. I mean, similar. They're similar methods, but I tend to drift more towards the discounted cash flow out of Monish's book personally. But yeah, I think if you're new to investing and you want to kind of get a easy to read book that definitely gives you some very good practical pointers on Warren Buffett's strategy and how to start thinking like Warren Buffett when it comes to making investments, then rule 1 is very handy. How many times have I said that? 1 million. We've said that a lot over the years.
Not sponsored.
Hashtag not. It should be. We've probably sold a fair few books over the time. Just from mentioning different books, we've probably made quite a few sales, to be honest.
Yeah. It's one of those things that obviously we'll never know, but I would love to know. I would just love if you could just figure out, how much traffic we drove towards his courses and his books.
Oh dear. All right. Should we do another one?
Yeah. So I got this one for you down here. Hey guys, love the podcast. Just wanted to know what stock was your biggest mistake and what lesson you learned from this.
Yeah, this is an easy one for me. Easy peasy.
Can I have a guess?
Yeah, go for it.
Is it a company called Sky and Space Global?
It is. You are correct, Hamish Hodder. What's yours? I don't know. Oh, you sometimes tell the story of that one that you invested in very early on, but I think that worked out in your favor, didn't it?
Yeah.
It was like, a AI company or something.
Oh yeah. Okay. Yeah, I've got a couple I could talk about. You take it first, and then I'll.
Essentially, Sky and Space Global. It's just like a penny stock. It was a speculative stock. To my credit, I always knew that it was a speculative stock. So, good on me. But I still lost all my money. So, so it wasn't really that good on me in the end. But this company, I've told the story before, was essentially trying to do what SpaceX is doing at the moment with Starlink, send up a lot of nano satellites, create a grid around the Earth in low Earth orbit to offer kind of telecommunication services. They just were a very small company. Their plan with the nano satellites was quite low cost, so that kind of got me interested, but they just ran out of money. They just did not have enough money to get the satellites up that they needed to start earning revenue to fund the new satellites. So they just kept doing more capital raises, and the stock price was going down and down, and then they do more capital raises. So to raise the same amount of money, they need to issue more shares. So the shareholders they got screwed in the process. They got diluted so much. I should actually go back and figure out exactly how much the shareholders got diluted. But it was an insane amount of dilution. And then they essentially just said, look, no, we can't get it done. Sorry. And I think the biggest lesson from that was not to just openly just blindly follow what the management team says they're going to be able to do. Do your own critical thinking, because I definitely was caught too much. I knew it was speculative, but I was caught too much in the idea of what it could be without focusing enough on how it could get there. And the management team were very much salespeople. They were talking about, oh, we're going to get it here. Trust us, guys. It's going to be fantastic. Don't even worry about how we're going to get there. We're going to do it. All their investor presentations were like, once we've got our nano satellites up, we're going to generate this amount of money. It's going to be fantastic. $4 billion in revenue in 5 years or something stupid like that. And they never really took the time to explain how, have they got the funding in place? Have they got the launch capabilities in place, the manufacturing deals, that sort of stuff to actually make it happen? So that's the story of my terrible investment in Sky and Space Global, and I ended up losing all my money on that one. So capital loss, and I'll offset it on some of my capital gains. There's a silver lining.
Yeah, and I mean, you mentioned. So I mean, I'm trying to think of my probably biggest mistake. I think the biggest mistake from mine would be I did invest in an AI data annotation company called Appen in 2017. And the reason why I got into that stock was not because I understood the business at all. It was simply because I was I was spending a day kind of shadowing a fund manager, and at one of the meetings they were talking about the company, and the guy basically just said, invest in this, it's about to go up. So I put money in it, and it did. It went up, and like you said, it wasn't as if it was a mistake, like it lost me money. I ended up getting out of it up quite a bit on it, but it was probably the biggest mistake because I just didn't understand the business. I had no idea what its value was. I had no idea where it was going in the future. I still have no idea what they do. What does Appen do? Can somebody tell me? No, I think they do data annotation, but I don't know what that is. I don't know. They also had they had a lot of revenue concentrated in a couple of big companies. And I think they recently lost one of those companies, so their stock got crushed. But I didn't really understand the business. Another mistake I would say, which again didn't turn out terribly, was my initial investment into Thor Industries, where I think I got that it was a great business. I think that part was fine, but I got the valuation wrong initially. Right. And that might have come from, not understanding the business well enough at that point. But my first investment into the business, which happened in early 2018, I believe, was not a valuation that I would pay today. So that would probably be another mistake that I made in that. Fortunately for me, the company went through a lot of short-term pain and the stock got extremely cheap. It's not fortunate for that first investment, but it allowed me the opportunity to kind of rectify that initial investment by making
silver
more
lining
at a lower price. So yeah, big silver lining for that one there. Yeah.
All right. Cool. I think should we wrap it up there? We're pretty much bang on an hour.
Yeah, it's been good. We barely made it dent into these questions. We'll have to.
We did 4.
What did we do?
5?
Yeah, 4, I think. Yeah.
4.
So
the problem is that we want to give good answers. Like many Q&As are just like blah 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 blah. Yes. Next question. But we actually take the time to like explain it. So yeah, we do. It does make us go a little bit slower in Q&A, but hopefully we'll just keep devoting more time to Q&A. Who knows? Maybe we'll just do a Q&A special podcast episode.
Yeah.
Or something. I don't know how or we'll just keep plugging away, but we'll see how we go. But anyway, I think that'll just about wrap us up for today. Thanks very much for listening, guys. Really appreciate it. As always, hope you found value out of the podcast. Hope you enjoyed it. Thanks as always to Hamish for joining me every week.
Worries.
Same time, same place. Love it. It's good fun. And thanks to Sharesight, of course, for sponsoring the podcast, really, and making it possible. And yeah, we'll see you guys next week.
See you guys.